You know, Scott, the first reaction you often get whenever you bring up accounting methods is that's just timing. But what's really important to keep in mind is that in a lot of cases, timing can be a tax director's best friend.
Well, James, I think you're exactly right. Traditionally, as you say, we see companies trying to accelerate deductions or defer income. But with potential rate changes, there's a lot of planning that can be done, including reverse planning. So, for example, if you thought that rates were going to go up, you might actually want to accelerate income or defer deductions. Where rates are static or, in fact, going down, you would engage in more traditional planning, such as accelerating deductions or deferring income. And in some situations where you have expiring attributes, such as foreign tax credits or net operating losses, there's certain timing planning that may be advantageous there.
Yeah, and we're seeing a lot of that these days, especially with all of the uncertainty in Washington regarding tax reform and tax rates and things of that nature. A lot of companies are being extremely proactive in putting together contingency plans that they can use to react quickly to whatever changes do come down the pike.
Well, the ability to react quickly is going to be very important, especially if you find yourself in a position of planning around rate changes. What you don't want to find a taxpayer is in a position of trying to react late and not having access to the right data, or in fact having missed some procedural deadlines. So, you know, in the methods world, there's quite a lot of planning that can be done, quite a wide variety of method changes. To give a couple examples, first think about advance payments, where a taxpayer receives payment in advance of providing goods or services. Traditionally, what taxpayers usually like to do is to defer that. There are procedures that allow for deferral of up to a year, or maybe more in some cases. An alternative is to actually pick up that income upon receipt of the cash. And where you're in a reverse planning stance, for example, where rates go up, you may want to consider doing that and then change back at a later date when possible. Another example that's fairly common is the so-called recurring item exception, where certain deductions may be accelerated. Commonly accelerated deductions under this regime are taxes and rebates. A taxpayer can simply change to a method of not using the recurring item exception, and for example, with those two liabilities, rebates and taxes, deduct as paid. And again, the taxpayer could switch back later on.
Yeah, and those are all really good examples. And obviously there are plenty of other ones, including, for example, if you incur a particular cost, do you want to currently expense it, or would you be better off capitalizing it and recovering it through depreciation? And if you do, how do you want to depreciate it? Do you want to claim bonus depreciation or not? And so in my mind anyway, a important consideration in any tax planning needs to be timing. And thinking about whether or not the company is actually better off in moving any item of income or expense from this period to another period, or vice versa, and being nimble in using accounting methods to react quickly to the changing tax landscape that we have in Washington, to take advantage of all of these changes and have your plan already in place. So obviously accounting methods are timing, but it's not just timing.
Well, it's interesting you mentioned fixed assets. One thing I hear a lot from companies about, and as I'm sure you do as well, is the so-called repair regulations or tangible asset regulations. So what are we hearing about those?
Oh yeah, we've been doing a lot of that throughout the past calendar year, because as most people know, the repair regs, the tangibles regs, were issued in late 2011, and originally they had an effective date of 2012. And so originally taxpayers had to start thinking about what to do with these regulations for their first tax year in 2012. But the wrinkle was that when first enacted, the government contemplated that taxpayers would have a couple of years to sort through these rules, to figure out what they say, to think through the nuances, and get their arms around their own facts before having to actually implement them. And so everything was really designed around a 2-year implementation period. Unfortunately, that message did not get through to a lot of people, and people really felt pressured in a lot of cases to implement the regs for 2012. So to take some of that pressure off, what the government has now done as of late last year is to actually defer the mandatory effective date of the repair regulations. So you can choose to apply the new rules for 2012 or 2013, totally voluntary. It's completely your choice if you want to implement them for 12 or 13. But they now become mandatory in 2014. So this delay is actually very significant and proved very beneficial to a number of our clients who were surprised at the amount of work that really was going to be entailed in getting their arms around these regs and their facts and whatnot. And the additional 2 years is really proving beneficial. So we were happy to see it.
Now, given this changing landscape, when do we expect Treasury to issue the final regulations?
Well, the most recent word out of Treasury is that we should look for them in late spring or early summer of 2013, with most of the regulations going final at that time. Small pieces of the regulations we're expecting to be reproposed, again, maybe in temporary form, but certainly reproposed. And that small piece would itself become final towards the end of 2013. So by the end of this calendar year, we think it will all be finished. And we'll have a final set of rules finally after all of these years. But notwithstanding that we think we've got a final set of rules on the horizon, we're still recommending that companies continue pressing forward with their planning. So for instance, what we're seeing is that for a lot of companies, particularly those in capital intensive industries, oil and gas, chemicals, heavy manufacturing, things like that, in a lot of cases they've been surprised at how much work has been involved in not only getting their arms around the new regs themselves and the new rules and the nuances in these rules, but around their own facts and sorting through their own fixed asset records and sorting through their own capitalization policies and coordinating with their financial side and with their operations side to figure out exactly the extent to which they're currently compliant with these regulations and also identify what opportunities there may be there for the company. So the additional time that you're going to get from continuing to press forward is going to prove a real boon in the long term.
So now, given that there's so much detail in the regulations, what do we tell companies to do at the moment?
Well, what we're telling people, frankly, is that it really depends upon your company's situation. But big picture, what we want people to do is to sort through your facts, continue sorting through the regs to the extent that we don't think they're going to change, and come up with a task list. What do you think you're going to need to do in order to, number one, be compliant with the regs, and number two, identify the opportunities that will benefit your company and sort that task list such that you can go ahead and start working on those items that relate to pieces of the regs that are not going to change and put on the back burner those tasks that are likely to need to be adjusted somewhat when the final regs come out. And we know roughly what is likely to stay the same and what likely will change, and can work with companies to prioritize that task list for them. We do it every day, and we've got a whole team of KPMG professionals around the country doing just that for a number of industries.
Well, clearly there's a lot of planning that can be done with the repair regulations as well as with methods in general. Mm-hmm. And one important thing to keep in mind is it's not too late for many accounting method changes to make a change for 2012. Mm-hmm. Thanks, James, for talking with me, and thanks to our audience as well for listening.